Thanks for tuning into BQ Conversations. I'm your host, Neeraj Shah. Our guest today brings in a good expertise of how equity investment and strategy is done in a large wealth management outfit, catering to, of course, the high net worth clients, but also a part of an outfit which has got a large global presence. So Rupen Rajguru, head of equity investment and strategy, brings with him the experience of managing large pools of equity money and the conversations and the intelligence of a large global unit as well. Rupen, great having you. Thanks for taking the time out.
Thank you, Neeraj. Good to be on your show.
Thank you so much. Rupen, what are the telltale signs or how are you reading the tea leaves currently as they stand when it comes to risk asset investing?
Neeraj, if you take the perspective of beginning of the year, probably we started the year with most pessimistic assumption, wherein we were expecting the risk assets, especially equities, to head down, more so because of expectation of US getting into a recession. But while we are like middle of the year, we are actually seeing a big risk-on rally, and the global markets, the risk assets, but typically all the assets which underperformed last year are doing exceedingly well, and all the assets which did exceedingly well last year, so let's be it commodities, are doing very badly this year. But the monopolistic tech is doing well, Bitcoin is doing well, and Bitcoin is a good indicator of what kind of risk-on environment is there globally. So having said that, from a purely India perspective, our markets are at its all-time high. While it's at its all-time high, YTD returns is say 4% so to speak. So it's not as high as US and other markets have delivered, which have delivered 15% return at an S&P 500 level. So net at this point of time, purely from an India perspective, the equities as an asset class looks pretty good. While it has gone up and it's always vulnerable for some corrections here and there, but we are on a good wicket, both from a micro as well as a macro perspective.
Okay, since you're constructive, and I'll come to the whole constructive part in a bit, but is there a worry, is there something that could spoil or upset the apple cart?
Neeraj, this has been the most anticipated recession, right? And everybody has been waiting for that. While mentally everybody's prepared for that, but whenever there is a big shock, or as they call the hard landing, and that's the time wherein the risk assets do tend to get very volatile. So the markets right now, unfortunately or fortunately, in last few years, there are no big cycles. There are a lot of mini cycles in the market, and some of these cycles we have seen it turning in few months. So to answer your question straight, probably if there is a hard landing in US, definitely there will be a risk off trade, and emerging markets, including India, is vulnerable.
Okay. On the converse, if indeed the US economy doesn't kind of slip into a recessionary move, because I hear some very strong thoughts from people who are in US or currently visited US and talking about the kind of consumption boom there. So if indeed that stays high, and if indeed the Fed doesn't bring down rates, or if anything hikes rates more than what the market anticipates, could that also be a negative for equities?
No, absolutely, because beyond a point, Neeraj, the incremental, so to say, benefit of rate hike, whether it's actually helping you in taming down the inflation, the answer is no. I think one of the key reason here, since 2020, if I'm not mistaken, US government has spent close to $8 trillion. The EU spending is close to $6 trillion. So that is the kind of money which has come in the hands of people. So in that context, it's very difficult to see the consumption boom kind of slowing down. So I would say it's a very difficult task from a Fed perspective, because incremental benefits of rate hike, it only gives an indication of what they want. They want the economy to slow down, but the other indicators, like as you rightly said, be it the unemployment data or some of the other economic activity suggests otherwise. So it's a difficult spot. But yeah, we have to wait and see how it pans out over next 1 or 2 quarters.
Just one quick question. I was talking to your colleague Mark Matthews about a couple of weeks ago, and the talk was that if you look at the Asian landscape, Japan is the unequivocal favorite relative to India. Now, my question to you is, as you speak to your colleagues about how Julius Baer as an entity is thinking about the emerging pack or the Asian pack, and while you sound constructive internally on Indian equities, is India very lower in the pecking order, or it's quite up there, even if it may not be the highest from a global allocator's perspective?
So from a mind share, you are right, Neeraj. India does not feature as the prominent market to invest in. But I would say increasingly what we are seeing a good amount of inquiries coming from large family offices around the globe, especially from the European side, because so far US FPIs are there in India, but Europeans are not as much in India. And in fact, from our side, we are looking into also launching our own AIF, specifically targeting these kind of investors around in Europe and also around in Hong Kong, Singapore, and Japan. So we are seeing good inquiries, and probably in a way, while intuitively as an Indian, everybody thought China's loss would have been India's gain, but probably it has been more of a Japan's gain purely from an FPI perspective this year. But I think we are, at least inquiry-wise, we are seeing a good amount of inquiries in India, and I think sooner than later, because these things do take time. They do their diligence and a lot of other stuff. But eventually, once they are convinced, they go by the allocation, right? So right now, from zero, even if some large investors, family offices, gets into 3 to 5% allocation to India, it's a good inflow from an India perspective when that entire thing is pulled in.
Got it. The other question, Rupen, is the optimism on India now, because you look at large pools of capital figuring their way out into India or otherwise, a large portion of HNIs within India trying to look at different asset classes too. Would you believe that a buck invested in India currently has the potential to grow meaningfully over the course of the next 4 to 5 years? Listed equities, I mean.
Absolutely. Neeraj, while we are too fixated with the current market levels and all-time high levels, but if we zoom back and see probably the decade of 2010 and 2020, that decade, the Indian equities delivered, or Nifty delivered 8% return, roughly, from 7.5 to 8. So it was actually lower than the nominal GDP. And if I were to compare in that decade, the fixed income in India, even liquid funds would have given 6.5% return, and liquid funds have also delivered 7+% return in that decade. So we had that, so to say, a lost decade as far as India is concerned. Last 3 years, clearly we are seeing both, as I said, improvement in micro as well as macro, because probably in between that 2010 and 20, macro was okay, but micro was very bad. And probably in 2003 to 8, we had good, macro as well as micro. So now this decade, we believe, at least as a starting point, we are, we have both positive, both at a macro level. By macro, I mean the balance sheet of the government as well as the balance sheet of the banks. And micro, I would say balance sheet of a household as well as balance sheet of corporate India. So all are in good shape. And probably, while we have seen a big deleveraging cycle amongst corporates, we believe next 4-5 years, we will actually see a bit of re-leveraging cycle also. So from that perspective, at least we believe next 4 to 5 years, the Indian equity market performance should be higher than the nominal GDP. And that is what was lacking in the previous decade. So to answer the question, we are constructive, and we believe for next 3 to 4 years or 5 years, Indian equity definitely is a place to be.
Got it. Now, what within this landscape are you guys preferring, Rupen? Because there are multiple ways or 1,000 ways to skin a cat. How do you think about this?
At a big picture, at times what we have seen many investors do tend to miss, because they look into timing the market. So the big picture here is, at least from an asset allocation perspective, clearly one has to be very much in equity. That's number one. Within equity, right now, probably, purely from a short to medium term perspective, market is fairly valued. There are no pockets of undervaluation, but there are good mean reversion plays. And in fact, this year, if you see, the market has seen good mean reversion. So be it a large automobile company or some of the ignored pharma stocks have given returns which are much higher than the markets. And probably just to bring back my original point where I said Indian markets, while it underperformed the global markets, but the internals of Indian market this year has been far superior than, say, global market, specifically US. Because in US, if you are not an investor in Magnificent Seven, your returns are hardly anything. It's a highly polarized market this year. But in India, if Nifty has given 4% return, 30 stocks in Nifty actually has delivered returns which are higher than 4. And the average return of that 30 stocks is 12%. So what does that indicate? The overall breadth of the Indian market is much better. And I think one thing which was ailing probably the fund management industry, again, in that last decade, was it was very difficult to beat Nifty. I personally believe next 3 to 4 years would be the year of alpha managers. And I think we have already seen in the first 6 months, the returns which the managers have delivered is much higher than the Nifty. So to sum it up, I would say we have to look into opportunities, and opportunities are there across. Some of the ignored sector, which we believe there is a scope of re-rating and, probably absolute alpha, are, healthcare is one sector. We also believe insurance is another sector which is there. And now probably amongst the financials, the big four banks also are on a relative basis much, reasonably valued as compared to what it was some time back. So I would say these are the segments which we like.
Got it. Rupen, just one last couple of questions. One is when one looks at the most spoken about theme, and that is the capital expenditure or the capex theme. Now, if I kind of request you to peel the layers a little bit and think deep about what within this bucket is investable, if you will. Some of the MNC names which will benefit from automation / expertise / global markets also opening up have been priced very well now. Some of the others are no longer at the nadir valuations that they were at about 6 to 12 months ago. And then, of course, there are the ancillaries which may benefit as a result of all of this. I'm trying to understand, are you guys constructive there across the breadth, or is it very specific here?
Yeah, a good question, Neeraj, and I think we also internally also have this conundrum, while we like the segment, but from an opportunities perspective at this price point, and then markets usually preempt earnings growth, specifically in this sector. So, as it happened in the previous cycle, I think the order book is determining the market valuation, right? So the earnings will come later, the market valuation has gone up higher. And historically, we have seen some of these companies, when operating leverage kicks in, their margin typically doubles from the turf margin. Their ROE actually goes up 2.5, 3 times. And we have seen stock prices, going up 3 to 4x. So we like this space. I would say it's very difficult to brush the entire thing with this, with the same layer. On a pure bottom-up basis, we are looking into opportunities there and buying into it. So it's not from a particular sub-sector which we like. From each and every sector, there are some bottom-up ideas which we like and which we would be constructive at. But at an aggregate level, I would say this theme we like might take a pause from a stock market performance perspective for the near to medium term. But over next 3 to 4 years, it definitely will give returns which we believe would be higher than Nifty.
Got it. Rupen, there is a fair degree of enthusiasm from global investors on pockets which either have the longevity of growth or got troubled in valuations. I mean, news on Wednesday is that GQG has invested a further $1 billion into the Adani Group, and we've seen a spate of 3 investments from a large global money manager putting the money there, and on record saying that there was a valuation discount. We've seen global funds shy away from information technology, where the growth is not looking all that great. And that has been a continuous process as well. Just love to understand from you, how do you read into situations like these? I mean, I'm not asking you for specific stock recommendations, obviously, but just your thought process around what happens, because that downtick that came in the Adani Group stocks was a big one, and then the subsequent investment. IT has been the central talking point for the last few months because of the impending slowdown. How do you think about these?
Again, Neeraj, just to quote, I know Howard Marks. So typically markets, wherein he talks about mastering the cycles, and market is never at equilibrium, and the pendulum is usually on either the side of optimism or pessimism.
Right.
So while we have seen, just an example, 2-3 years back, some of the themes which were so-called untouchable, be it public sector companies, be it defense, be it railways, and absolutely they were at rock bottom 8-10p multiple valuation. And today the pendulum is completely swung on the other side, right? Wherein I would say that those are trading at 25-30, even higher multiples, some of the names. And since you mentioned IT, and I think one of the sector which probably would be a dark horse would be IT, because just imagine, if you interviewed any fund manager in, say, December of 2021, what was the thing he was talking, from an IT perspective. IT is the, IT 2.0, clearly big theme on digital transformation, cloud 2.0. Attrition was the biggest issue, right? The companies were facing attrition of 25-30%. The wages had gone off the roof. And today, if you see, it's completely the other side. The pendulum has swung, and IT companies themselves are also much more conservative and about talking about the growth estimate. So I would say the market valuation adjusts, and things are never as good as it appears, or never as bad as it appears. So we have to look into from the lens of whether it is getting into the other side of pessimism. So probably I would say, hopefully this quarter might determine the bottoming of IT sector, because this quarter all the pessimistic commentary would be there, or the growth might be, at least for the big guys, we believe 0 to 1% Q-on-Q growth, and it might mark the bottoming for that sector. And mind you, if the valuations are not at a significant premium to the market, these companies enjoy very high ROEs. They constantly do buybacks. They have a payout policy, so dividend yields of some of these companies would be 3 to 4%. And remember, right, we had a tobacco stock 2 years back, and everything that could go wrong went wrong, and rest is history, right? So we have to be mindful of that and be opportunistic to take advantage of these whenever there are these mispricings.
Got it. Okay. Rupen, great having you. Thank you so much for taking the time out and being with us, and look forward to having more of on the platform.
Thank you very much, Neeraj.
And viewers, thanks for tuning in.